This is our Forex blog for June 24th, 2014. These are our currency indexes, which let you see visually what each individual currency is doing. For instance, the dollar is pretty much going sideways for multiple hours and breaks out and goes up. Obviously, that's a very high probability direction for the next couple hours, and that's what happens. You want to trade that strong dollar against whatever currency is weak at that time, which is right around 8 o'clock. The euro's been going up, and it's actually above our upper containment band, so it's probably more likely to go down than up. So you could be looking for euro-dollar sells after 8 o'clock. Let's take a look at our regular 5-minute chart. And you can see by looking at the chart, looking for sells after 8. We have a nice little trend line right here, and it didn't initially fall off a cliff. But if you took the second short, where you hung in the first one, initial stop here, went down, went sideways, you move your stop tighter, you ultimately made 45 pips on that trade. It's probably best to find one that's already in a downtrend, such as the Australian. So strong dollar, weak Aussie. You want to look for sells, especially at 8, and take a look. You see this nice little rectangle wedge pattern here. 8 o'clock, you look to sell it, you put your stop above here, makes a new low, tiny little pullback, you move your stop down, makes a new low, tiny little pullback, you move your stop down, and typically it will go to the fib target, the 1.618 of the first move. Sometimes it makes its way to the 2.0 move, but the majority of the time, probably 80% of the time, you're only going to make the 1.618 fib target. So you know ahead of time if you sell this low right here, this is your risk, this is your potential reward, and you can see the reward is 2.5 to 3 times bigger than what the risk is. And that's why our tools and trading can be profitable as long as you focus on trades that are likely to give you 1.5 to 2 times bigger wins than your risk. You're going to do fine. Let me just showcase how our signals did today. You can see the initial risk of this first trade was this, very tiny. It actually generated this. Second trade, it got long right here. This was initial risk, and it lost that amount. Then it had this trade right here. That's initial risk, and it made this amount, which is over 3 times more. And then this is the initial risk, and you can see it's already locked in. It's already up money in this trade. It can't lose at this point. So that's the key to trading. Small losses, bigger wins. Here's the pound. Started off today with a trade here that lost. Then it risked this amount. It made this amount. So about 3 times bigger win. It risked that amount and made that amount, so over 2 times, 2.2, 2.3. That was a risk. In this case, it had a slightly smaller or approximate win compared to the risk. And then it is in a trade here, which you can see has, although it has not yet closed for a profit, it is in the money right now, and the risk is 1/3 of what it initially was. So not every losing trade is going to have a huge, or I should say, the size of the initial risk. Here's the Aussie dollar again, and you can see the first trade here, the risk versus what it generated, and it actually flipped from a short to a long, so it got out right on the close of that bar. Then it went long right here, got out right here with a very tiny win. Less profit than what the risk was, but we'll take it. Here's the risk. Here's where it got stopped out. So pretty much break even. Nothing to be too upset about. Then you go short right here, and it generated this. 1.5 to 2 times bigger win. and it didn't buy the lows because it wasn't down, or it didn't go below an extreme amount, and didn't have a certain bar pattern that is predictive of reversals. So you can use our Forex signals to trade if you don't know what you're doing, or you can just simply, find a currency that's weak, like the New Zealand here, and trade it against a currency that's strong, like the dollar or the yen for later in the day. Let's just close this blog video with a New Zealand dollar. We're looking to sell it, especially after 8. And you can see after 8, here's the low. It came up and made a double top right here. If you want to get short right here with a very, very tiny risk, you can see it made its way down. This is a pretty decent place to get out when it goes sideways for 2 hours. It's probably going to pull back up, go short again, and the farther down it goes, the less profit you're likely to make. Here's the New Zealand yen. And again, weak New Zealand, strong yen. You look to sell the pullbacks. This is your risk. This is your reward. Risk. You're never going to catch every pip, but somewhere in this area would be probably 4 or 5 times bigger profit than what your risk is. And that's the key to trading. Doesn't matter what method you use. If you're right 55-60% of the time with equal sized win versus loss, or you're right less than 50% of the time and you have 2 or 3 times bigger wins and losses, either way results in profits. And the best traders are right 50 to 60 or 65%, and also have 1.5 to 2 times or more bigger wins than what the risk is. And that's when you really do well as a trader.